Sort of right, sort of wrong. I do think people are over-focused on the direction of change, what I call derivitis, which is too much focused on the derivative. So inflation is commutative, meaning 2% followed by 3% followed by 4% followed by 5% is just as bad but no worse than 5% followed by 4, then 3, then 2. The order doesn't matter. And so people get too excited about a change in the rate of inflation. We still have very high inflation. We still have very negative real rates of interest, and negative interest rates prop up growth stocks and are relatively good when they change to value stocks. I said a lot there, but people are too positive about a decline from very high inflation rates.
You don't think it's more important that the inflation rate is falling than the absolute level, that it's still high?
I'm so glad you followed up on this, because this is one of the real misunderstandings that people have. If your daughter graduated from 8th grade last year, in 4 years, you're going to have to write a college tuition check. If inflation goes 5, then 6, then 7, then 8, it makes no difference if it goes 8, then 7, then 6, then 5. It's exactly the same, because multiplication and inflation are commutative. What's happened is there's been a massive erosion of the purchasing power of a dollar. Last year's 7.5%, this year's 8+ is going to mean you can buy 15% less stuff than your money than you could 2 years ago. That's what matters, not the direction and the rate of change.
Well, I think a lot of people do disagree that the direction of travel is important. But I do want to bring in some sound to this conversation, Charlie, because earlier today, Richmond Fed President Thomas Barkin discussed on CNBC what the Fed will have to do to get inflation to a comfortable range. Listen.
We're happy to see inflation start to move down. And I'd like to see a period of sustained inflation under control. And until we do that, I think we're just going to have to continue to move rates into restrictive territory.
Which sort of goes to both points. But the obvious point from the Fed, and his message is the same as some of the messages we've heard post that inflation report, is that they have a lot of unfinished business here.
No, absolutely. And they're right about that finally, after having been very late to the game. But they're taking, and there have been all kinds of articles in the last couple of days, taking way too many victory laps over a decline in the rate. That is the point. And I'm glad we are spending a lot of time on this, because it is important. It is much worse to go from 8 to 7 than to go from 2 to 3. It is not the rate of the change in the rate. It's the purchasing power of the dollar that matters.
Understood, Charlie. So you're still investing for an inflationary environment is the bottom line.
That's a great way to put it. And a 3% 10-year or a 2.8% 10-year, when we are going to have absolutely north of 5% inflation next year, and we're going to have more than, in my opinion, 2.8% over the next 10 years, means we've got negative real interest rates, and that's got big implications for whether you should own bonds. And it's got big implications for growth stocks, which clearly have a tailwind of this very low real interest rate environment, which I think is going to revert back to mean.